Thank you very much, Aurelian, and good morning, good afternoon, and good evening, everybody. It's a pleasure to be here. What we'll try to do today is we'll go through about the three consultations which are from the IIS, which are out now, one on ICP 14, ICP 17, and also about the candidate ICS as a PCR. Can we go to the next slide, please? I think in a we will cover for ICP 14 and 17 a bit of background, and also we give you an update about the changes we made to the ICPs. We'll then move to the in ICS, or the candidate ICS as a PCR consultation, and we'll give you a bit of the background or how did we get to this point and get into the details about the consultation document and give you an overview of the changes between the ICS 2.0, which was agreed in Abu Dhabi, and the candidate ICS as a PCR. And without further ado, I'll let my colleague Sandy Schaefer, which is the vice chair of the Capital Solvency Field Testing Working Group, to take you through ICP 14 and 17. Sandy, the floor is yours.
Hi, Paolo, and thank you for the introduction. If you want to move on to the background slide. Just to give you a little bit of context here, we decided to delay the review of ICP 14 and 17 as part of the overall review of the ICPs, as we were still working on the ICS and wanted to allow for as much time as possible before we took on these two ICPs. So these were done sort of subsequent to the initial review. As a reminder to those on the call, ICP 14 provides the requirements and related guidance on the valuation of assets and liabilities for solvency purposes, and mostly related to financial assets and insurance liabilities. And then ICP 17 covers capital resources and capital requirements, and also includes internal models. So these two ICPs are slated to be adopted along with the final ICS at the end of the monitoring period. And after that, we will go back and integrate these ICPs in with ComFrame. So that'll happen after December 2024. So starting with ICP 14, most of what we were doing is you could term cleanup versus an overhaul. So we were really trying to make the ICP a bit more readable and more straightforward, and work through just trying to get everything consistent and readable, and so you won't see a whole lot of material change to the standards itself, to the standard itself. So we did include a couple of things that are, I guess, a little bit new, just to give you a sense for what was done. We included the concept of fulfillment value. That's the measurement value. That's the measurement concept that's contemplated in IFRS 17, and it relates to the measurement of insurance liabilities. It's sort of an entity-based perspective versus a market participant perspective. So that was one thing that we've included and added to the glossary. We left intact the measurement concept where an economic basis may be satisfied by either a market consistent current value or amortized cost. And amortized cost in the context of insurance liabilities was clarified with an example to mean a reserve-specific calculation. Overall, the valuation of assets and liabilities should reflect a risk-adjusted present value of cash flows, and we didn't change anything about that. So overall, the main parts of ICP 14 are unchanged. So moving on to ICP 17, so similar to ICP 14, the changes were mainly the cleanup nature. This is also the longest ICP in terms of number of pages. So an effort was begun to try and shorten this where possible. I think we've got more work to do on this one. It's still, I think, close to 100 pages. So similar to ICP 14, we went through and made some changes in terms of making sure there's consistency throughout and also consistency with other ICPs. So one change in terms of that is when we reference a company in resolution or liquidation, I think this term replaces text that used to refer sometimes to a wind up or a winding up. So we're now using resolution slash liquidation in place of that. And there were some other just sort of terminology changes that we made just to make things consistent. And you can see that on the slide: capital resources versus regulatory capital resources. And you know, where we're talking about a supervisor or a group-wide supervisor or involved supervisor, we made those also consistent within the ICP and among across the different ICPs. So I think that's all we have on ICP 14 and 17, and I'm going to pass it back to Paulo now.
Thank you very much, Sandy. And just to let's start now with the ICS, and we'll give you a bit of the background on how did we get to this consultation paper. We can move to the next slide. Yeah. So, what is the ICS and what are the key components of the ICS? So, just to remind you that it is a quantitative element or frame, and it applies to International Active Insurance Group. So it is a consolidated group standard. It does not apply to a legal entity, and it's a minimum standard that all IIS members will implement or propose to implement, taking into account specific market circumstances. So the focus is on insurance activity, and when it comes to non-insurance activities, Sandy will explain later, that will typically refer to sectoral requirements, for example, Basel III for banking activities. It has three main components: valuation of assets and liabilities, capital requirements, a measurement for capital requirements, and criteria, consistent criteria for capital resources, what we call qualifying capital resources. And in terms of risk coverage, it reflects all material risk of an international active insurance group's portfolio of activities, taking into account assets, liabilities, non-insurance risk, and off-balance sheet activities. If we move to the next slide. Now, how did we approach the development of the ICS? I mean, first of all, developing the first global standard for insurance is certainly a complex matter, and the journey to get where we are now has been quite long. We started around 2013. It hasn't been a marathon, certainly more than a sprint, or actually a marathon made of a set of sprints, I would say. And since its announcement in 2015, we follow a structured and evidence-based approach to develop the ICS, and undertaking a multi-year field testing with a number of volunteer insurance group. Next slide, please. So I was saying about a multi-year approach to field testing. We're taking 6 field testing exercises through 2014 and 15. For each one of them, we prepared technical specification, and we had dedicated a workshop summarizing the data and so on. But most importantly, these are being developed by the Capital Solvency Field Testing Working Group, which is made up of members from more than 25 jurisdictions, and each year, especially between September and December, we spend at least 2 weeks in the Basel dungeon, analyzing data, summarizing data, producing report. And we're very grateful to the 40 to 50 volunteers that each year have participated, providing data, feedback, and so on. And we in addition to field testing, we try to reach out to a broader group of stakeholders. We had in-person stakeholders meeting, and most importantly, we had 3 consultation papers preceding this one in 2014, 16, and 18. And we had lots of meetings with our volunteer insurance group constituency. Next slide, please. I mean, Certainly, our goal to develop an ICS was to develop a truly global insurance capital standard for international active insurance group. We've been striving to create something that is unique, and by that means that need to work for different firms, markets, and supervisor across the world. This is certainly very difficult because the different valuation methods and capital standards which are currently in use by different jurisdictions to assess group capital adequacy. Nevertheless, we made significant progress over the last few years. We think that the convergence process is certainly possible. Next slide, please. Where are we now? At what point are we now? If you look at these slides, it illustrates the process which are gone to the 6 field testing exercise, which we call development stage. And now we are at year 4 of a 5-year monitoring period, and which will conclude in end of 2024. And by that time, we need to take a decision about what we like the ICS as a PCR to be, and also, quite importantly, we need to assess whether the aggregation method provides comparable outcomes to the ICS. And after that, if starting from 2025, we'll be talking about implementation of the ICS as a group prescribed capital requirement. Next slide, please. Moving to the ICS consultation document. Just to remind you, this is the 4th public consultation. So we had, as I said before, we had 3 public consultations in 2014, 16, and 18, which were exploratory in nature. But now the IIS is consulting on the near final version of the ICS. This is the last public consultation before the standard is adopted and becomes subject to implementation by IIS members. Through this consultation, we're trying to get feedback on all aspects of the ICS, and we have specific questions on each one of the sections of the consultation paper. In addition, the current consultation document also provides specific background information and target questions to the changes we have made between ICS 2.0 and the candidate ICS as a PCR. Next slide, please. Now, just about the structure of, to help you a bit, what is the structure of the current consultation document? The current consultation document is divided in, ideally divided in 3 parts. This is the introductory part, which is section 1 and 2, which provides a bit of information about the history of the ICS and the past consultation, including the principles that we use for the development of the ICS and the history. Then there is the core part, which goes from section 3 to section 9, which contain the standard in itself. So you will see paragraphs which are numbered like L1 and L2, which represent the level 1 text and the level 2 text, together with some background explanation and on the consultation, which you'll find it in the blue box. The blue box will give you a bit more background, and especially will underline and stress what have been the changes between ICS 2.0, which was agreed in Abu Dhabi, and the candidate ICS as a PCR. And then the third section, which is section 11, quite important, and that's why, because it contains provide information on the economic impact assessment and contain all questions on economic impact assessment. So we expect also for the process to be complete to receive lots of feedback also on this section. Then after all this section, we call out section 10, which includes a catch-all question, which offer the possibility to stakeholders to provide any other feedback which has not been captured by previous questions. Then on top of that, we have 4 annexes, which complement the core part. Annex 1, which covers the treatment on non-voting interest entities, and Annex 3, which talk about definition and criteria applicable to the infrastructure debt and equity, are an integral part of the standard. So the part of the level 2 text, but for ease of reading, we kept them separated and as an annex. But these are important because they are part of the standard. Next slide, please. Now, moving to the ICS economic impact assessment. You may remember that as part of the Abu Dhabi agreement in 2019, the IIS committed to produce an economic impact assessment on the ICS before its implementation as a PCR, which starts from 2025. The purpose of the economic impact assessment is to assess potential significant impacts arising from the introduction of the ICS, and the focus on four areas: product availability, AIG's business model and capital position, impact on financial market, and impact on implementation of the ICS. The economic impact assessment, what's quite important, will draw on the quantitative and qualitative data which we collected during the 5-year of the monitoring period, including the responses to the question which are highlighted in section 11, which is part 3 of this consultation document. Next slide, please. Now, what is quite important for us that is, as they typically tend to work mainly with the volunteer population and with a restricted number of stakeholders, this consultation on economic impact assessment would like to receive responses from a much wider range of stakeholders, which certainly goes beyond the IIGs and the insurers which are directly impacted by the introduction of the ICS. And we look into other market participants like rating agency, industry bodies, non-international active insurer groups, investors, and consumer bodies. And the outcome of this assessment will be considered when finalizing ICS and will support the implementation process of the ICS as a PCR. Next slide, please. Now, just to give you a very brief list of the evolution, Gilbert and Sandy will get into more detail. What changes did we make between ICS 2.0 and the candidate ICS as a PCR? Now, looking at the valuation side, we made adjustment to the eligibility criteria for the middle bucket. We also recognized the multiple portfolio within the same currency for the middle bucket. We also reassessed the contribution of non-fixed income asset to spread adjustment, specifically equity, for example, introduced a term structure for spreads. We also included a modulation factor to limit the impact of the spread adjustment in some cases. And then on capital resources, what we did was we introduced a limit for the recognition of minority interest. We also made some adjustment to the eligibility criteria for Tier 1 limited and Tier 2 financial instruments. Now, in respect to the capital requirement, we revised the non-default spread risk, and this is tied to the changes we have made on the market adjusted valuation, is more specifically, as Gilbert will tell you, with the introduction of the term structure of spreads. We updated the life risk calibration in light of new data received, and also we introduced a differentiated treatment for investment in eligible infrastructure, debt, and equity. We also introduced a counter-cyclical adjustment for equity risk. We introduced some optionality in the calculation of the non-insurance risk charge. When it comes to tax, and this Sandy will pick up this one, we also introduce and simplify the approach for the recognition of tax effects on the ICS capital requirement. And when it comes to other methods, we recognize the use of internal models for the calculation of capital requirement. And also, we formalized the use of supervisory owned and controlled credit risk assessment, SOCA, for unrated exposure in the credit risk calculation. And this concludes the first part. I'll let now Gilbert to drive you through to the specific adjustment we made to the market adjusted valuation. Gilbert, the floor is yours.
Thank you, Paolo. So like what Paolo mentioned, I will cover the sections relating to the changes to the ICS market adjusted valuation basis. If we go to the next slide, thank you. We will start with the criterion L2-69D of the ICS consultation document. In comparing the market value of liabilities to assets in the middle bucket portfolio, the market value of liabilities is now determined using the general bucket curve instead of the risk-free yield curve. Next slide. For criterion L2-69E, we have made the following changes. Now, firstly, premium cash flows that are at the discretion of the IIG would not be precluded from qualifying for the middle bucket. This is because changes that are at the discretion of the IIG does not decrease the predictability of these cash flows. Secondly, products with certain policyholder options, such as top-up options or paid-up additions, which are quite common in the industry, would not be excluded automatically from the middle bucket. However, these cash flows should be unbundled and included in the general bucket as they decrease the predictability of the IIG's cash flows. If we go to slide 25, we have also introduced the flexibility of allowing for multiple middle bucket portfolios in a single currency to recognize how an IIG would manage their insurance liabilities. However, each portfolio by itself would need to satisfy all of the middle bucket criteria. Criterion L2-69A also requires each middle bucket portfolio to be ring-fenced, and this means that there cannot be double use of any assets within the portfolio. Slide 27, thanks. Next, we go to the changes to the treatment of non-fixed income assets or NFI assets. As the general and middle buckets are conceptually different, and there are additional safeguards put in place for the middle bucket, a different treatment of NFI assets have been introduced for these two buckets. More specifically, NFI assets have been excluded from the calculation of the middle bucket spread adjustment. Before this revision, NFI contributed to a spread of 0 and therefore lowered the spread adjustment if they are present in the middle bucket. For the general bucket, the approach has not been changed. That is, NFI continues to contribute a 0 spread. We go to slide 29. Now we go to the credit spread term structure. As you would be aware, in ICS version 2.0, the yield curves for the general and middle buckets were obtained by taking the risk-free yield curve and adding a flat spread adjustment. Next slide. However, given that credit spreads typically vary by maturity, we have collected information during the monitoring period, which has allowed us to specify credit spreads that varies by term structure. Next slide. In general, the introduction of a credit spread term structure would lead to a lower spread adjustment for shorter maturities and higher spread adjustments for longer maturities compared to the design in ICS version 2.0. Next slide. So in summary, we have introduced a spread term structure to determine the general and middle bucket yield curves using the Nelson-Siegel approach. Consequently, the NDSR stress, which was previously based on the flat spread, has also been revised to maintain consistency with the spread term structure design. We will be covering NDSR later. If we go to slide 34, the final change on MAF relates to the modulation factor. In times of credit spread stress, we identified the risk of overshooting where the release on the liability side is bigger than the loss on the asset side. This leads to a counterintuitive situation where the solvency position improves under stress. To mitigate this risk, information on the modulation factor was collected during the first 3 years of the monitoring period. However, we found that the design of the modulation factor was too conservative, as it assumed that an increase of 1 basis point in credit spread leads to a corresponding 1 basis point increase in discount rates. But not all assets would contribute to the spread adjustment for the middle bucket and general bucket, and the application ratios would further reduce the effect. Next slide. Hence, we have introduced a revised modulation factor that takes into account the application ratios for the respective buckets and the weights of spread contributing assets. This would remove the conservatism of the modulation factor and at the same time address potential overshooting. Now, I think this is the last slide on MAF. For the next section, I'll pass to Sandy. Over to you, Sandy.
Thank you, Gilbert. So I'm going to go through a couple of changes that we made to the capital resources section. These were not necessarily significant, more like tweaks to the capital resources section. So if you move to the next slide, please. So we endeavored to take a look at a fungibility of capital as it relates to the ICS and the solvency measure. And there are many areas where we could have delved into fungibility on the ICS, but we decided that we would tackle what we consider to be sort of the most important item, or an item of a more material nature, and that was related to non-controlling interests at the subsidiary level. And what we determined was that non-controlling interests can really only contribute to solvency up to the contribution of that legal entity or subsidiary to the capital requirement within that that's derived within that entity. So we're trying to figure out in this calculation the amount of contribution from a subsidiary that could be counted, or the amount of non-controlling interest that could be counted against that capital requirement. So in the formula, we're coming up with a measure. It's an estimated measure of the amount of capital requirement for a particular entity, and we do a ratio and then use liabilities as a proxy to multiply against that ratio, and that gives us a limit that we apply against the non-controlling interest. So in a sense, the non-controlling interest contribution cannot be more than the amount that the capital requirement contributes to the total group ICS. So that is how that calculation will work. So it's a limit on the amount of non-controlling interest that can be counted towards capital resources. Next slide. So the other thing that we looked at based on feedback and our analysis, we had discussions with volunteers and among ourselves about some refinements having to do with which types of calls would be allowed for certain Tier 1 and Tier 2 debt instruments. And those refinements, these refinements that I'll walk through should allow for inclusion of a limited number of additional financial instruments in the Tier 1 limited and Tier 2 categories. So more specifically, if we move to the next slide, so under criteria for Tier 1 limited instruments, the requirement of prior replacement in the first 5 years we determined was not really aligned with market and regulatory practices, and resulted in an exclusion of instruments that we believed were sound forms of capital. So we made some tweaks here, and in the slide, essentially what was changed was that we added an element where economic calls that were made for economic purposes, meaning the instrument can be replaced at a lower cost for the issuer, would be subject to supervisory approval and prior replacement, and we would remove the subject to the prior replacement for the tax and regulatory type calls. So that's a small tweak, but we felt that that was unnecessarily excluding certain instruments that we felt should be included in this category of capital. So on the next slide, this is similar, but for Tier 2, again, we're sort of tweaking which calls are allowed and how. And this one, we added the ability to include instruments that can be called at a make-whole price, and also the call for tax and regulatory events. And both would be actually. Let me step back. So we continue to have the calls within the first 5 years are subject to prior replacement unless the call is linked to tax and regulatory and or can be called at a make-whole price. So the one thing I will say about this one is that this particular tweak is going to be on a grandfathered basis, so on a transitional basis, and is not going to be included as a future change. It's just for existing instruments. So I believe Gilbert's up next with the capital requirement section.
Thanks, Sandy. So like what Sandy mentioned, I will now go through the changes to the ICS capital requirement. We start with non-default spread risk, or NDSR. So for NDSR, we have made some changes to the design and calibration of the module due to the introduction of the spread term structure, which I described earlier. As mentioned earlier, the credit spread adjustment for liabilities will vary by term structure. Hence, the approach to NDSR has also been amended to move away from absolute to relative shock. A relative shock of plus or minus 75% has been introduced in the NDSR up and down stress scenarios up to the last observed term. If we go to slide 45. So now on life risks, the data collected during the monitoring period had indicated the need to adjust some of the stress factors. For the candidate ICS, the stress factors have been revised for two segments. The first segment is mortality risk for business underwritten in China, which has been increased from 12.5% to 15%. And the second segment relates to morbidity disability risk for long-term category 2 for business written in Japan, which has been increased from 8% to 15%. Okay, we go to slide 47. For equity risk, a counter-cyclical measure called the neutral adjusted dampener on net has been introduced to reduce the equity risk charge during a sharp equity market downturn and increase it during an upturn. The net aims to counteract the effects of equity market changes on IIGs and thereby reducing the risk of pro-cyclical investment behaviors of IIGs such as fire sales. Now, just to note that the counter-cyclical measure is viewed as a macroeconomic tool, and it is meant to reduce systemic risk. If we go to the next slide. Now, for infrastructure equity, a differentiated treatment has also been introduced. In order to qualify for the differentiated treatment, infrastructure equity would need to meet certain definition and criteria, which have been included into the consultation document. Within the existing equity segments relating to developed and emerging markets, sub-segments for infrastructure equity have been created. For infrastructure equity, the risk factors have been reduced by about 23% based on the analysis of data collected. An explicit correlation assumption has also been introduced between infrastructure and non-infrastructure equity. So if we go to one more slide, for infrastructure debt, we have introduced a new exposure class, which is subject to the definitions and criteria provided in the consultation document. The specific risk factors for unrated infrastructure debt has been reduced by about 25% compared with the unrated corporate exposure. For the next few slides, I will pass back to Sandy. Sandy, over to you.
Thank you, Gilbert. So the next change relates to entities that are outside of the insurance calculation. So these are the non-insurance entities, and specifically, these are financial entities that are non-banking entities. And in the ICS 2.0, we essentially had what you could consider an operational risk calculation, where we took 15% of a 3-year average gross income as the capital charge. That was somewhat modeled off of the Basel approach for banks, and in the interim time period, the Basel approach for banks has changed. So they essentially created a little bit more granularity in their calculation to better capture the operational risk within the Basel rule. And so what we decided to do was kind of take a two-tier approach. So we have the option at the option of the group-wide supervisor, we have either the 15% 3-year gross income charge, or if that's not all that reflective of the risk, or the risk could be better reflected using the Basel approach, that could also be applied by the group-wide supervisor, which, as I said, has a bit more granularity associated with it, and also uses some statistics related to actual losses within an organization. We also took a look at this rule and also realized that there's potential that other risks may be included in a subsidiary like this that would not necessarily be captured by something along the lines of an operational risk charge. So we added sort of a catch-all at the end that risks not covered by such a charge could also, the group-wide supervisor could also include an additional charge for those types of risks. So an example might be an entity that had a trading book or had some forms of credit risk that are not banks, that would not necessarily be captured by an operational risk charge. So that covers that section, and I think we're moving from capital requirements to tax. And so in tax, we've made attempts in the past to try to estimate the utilization of the tax effect of the capital requirement. And those attempts were relatively complex and generated some unwanted effects and did not necessarily, in our view, increase the accuracy of that calculation. And so we've introduced a much more simple approach, and we believe it will yield very similar overall results in the ICS. Sorry about that. That's just my vacuum. Bad timing. So in terms of the simplified approach, if a group-wide supervisor determines that that a more complex approach would be warranted to deal with the utilization of the tax effect of the capital requirement, we have the option of using the more complex approach that we developed in the earlier iteration of the ICS. So that's it for tax. And then moving on, GAAP Plus, for those on the call, as a brief background, this is an alternate valuation approach under the ICS, and it's based on consolidated audited GAAP financial statements. This, along with internal models, was tested in ICS 2.0. It was decided that under GAAP Plus, that although GAAP Plus is a viable option that could be considered for a future version of the ICS, if requested by a supervisor, it would not be part of the candidate ICS as a PCR. One of the reasons being that the IFRS GAAP Plus approach requires further development and refinement before it could be considered ready as a viable option, and that was basically because of the delays in the implementation of IFRS GAAP Plus and other constraints that we faced around that. The US GAAP Plus approach was developed, but again, until we reach a period of time where it's requested to be used by a group-wide supervisor, it will essentially just be continue to be collecting data on that as part of the monitoring period. So for the other GAAP Plus approaches, Japanese GAAP Plus, Chinese CROS, and the US statutory approach, those are set aside for future consideration if requested by the supervisor as well. So that covers.
Sandy,
Yep,
Sandy,
sure.
yes, just excuse me, just a message for participants, because most of them are dialing in. So we just send an email with the presentation for them, so they can now follow the presentation. So the slides have been posted on the website, so they can follow, and we are on slide 56. Thanks.
Great, thank you, Ramon. Okay, I've got one more slide here. So other methods, these are other methods for calculating the capital requirement. And we made a small, if you go to the next slide, we made a small change to the supervisory owned and controlled credit assessment framework. You know, the example for people on the phone are like NAIC designations. We made a small change to the scope for these, for the use of SACA, the SACA framework, and SACA ratings were only going to be considered for unrated exposures. They are not considered for rated exposures. So that was a small change that we made to the scope. And then we confirmed in terms of where this approach would fall out in terms of the standard. This would be included as an other method, meaning an other method of calculating the capital requirement. So I think that's it on my side, and I'm going to pass it back to Paulo for internal models.
Thank you very much, Sandy. And final slide, internal models. I mean, as you've probably seen from the consultation document, in the candidate ICS as a PCR, internal models are now recognized as another method for the calculation of the ICS capital requirement. Having said that, in the use of internal models is subject to requirements related to the development, use, and maintenance of the model. So we're talking about requirements related to approval of internal model and maintenance post-approval of the internal model. And this, I think, concludes the set of slides we had to present to you, and we can now open the floor to questions. I'm really sorry about the IT inconvenience. So who would like to start? And consider that we don't have people, people are dialed in over the phone. How are we going to collect questions? Aurelian?
Yeah, no, that's a good good point, and probably, well, the only way I would see it right now would be to send an email to the host, so Sylvie, and either requesting for the floor or typing the question itself in the email. And yeah, then we could read out the question aloud and answer it. And of course, we could give a few minutes to participants to send an email.
In alternative, can you open the floor and ask people to
Speak up?
Yes. If you
Sylvie,
can open all the lines, that would be fine.
Okay, let me. Sylvie, is that something we can?
Yeah, I can unmute attendees. Huh?
Okay, so yeah, let's try this.
So lines are now unmuted, so if you would like to step forward and ask questions.
It's John Jenkins from Milliman in the UK. A question, please, on the approval of internal models under ICS. Who approves the model? Is it the IAIS itself, or is it the local lead supervisor in the country in question?
Okay, I mean, we have to bear in mind that the IIS requirements do not have immediate effect into international legislation. So IIS standards will need to be implemented by jurisdiction. And as per CONFEN, the group-wide supervisor will need to approve the internal model.
Thank you.
Next one.
Appreciate the fact that you just sent it out the slides to us. Can you hear me?
Yes, Stephen, loud and clear.
Okay, thank you very much. We've appreciated that in the in the ICS consultation document you have set forth the changes in the candidate ICS from ICS 2.0. One thing that is a little bit harder to tell, though, is the changes that have been made as a result of the 2022 data collection and other, and other input that the IIS received. Is there any way to indicate more clearly what the changes from last year's version of the ICS were?
I'll let Aurelian to respond to that, but I think you'll find that actually the changes from last year's version of the monitoring period will be the one which have been highlighted in the blue box.
Yeah, so actually there are two ways to identify those changes. So Paolo, you're right. In the blue boxes of the consultation document, we made a description of the changes made, more or less at a high level. Another tool you may use is that, so we published last week at the same time as the consultation document, the public versions of the technical specifications for this year data collection. And in the part 2 of those technical specifications, all changes made since last year appear in tracked changes. So that the changes between ICS version 2.0 and candidate ICS as a PCR will appear in tracked changes in the part 2 of the technical specifications that were posted end of last week. So that's also a document you may use to identify the changes made.
And there have not been any.
Thank you very much.
And Stephen, there have not been any other changes since the beginning of the ICS monitoring period, apart from one mistake which was done on year 2 and the formula was corrected. All the other changes are more clarification and editorial changes to the text.
Okay. Thank you very much.
Next.
Hello, this is Tobias Lassmann from Swiss Re. Can you hear me?
Yes.
Thanks a lot for the event and for the opportunity to ask questions. My first question would be, I understand that once the ICS is adopted, it will be integrated into the COM frame as its quantitative component. Does this mean that we can expect changes to the COM frame ICPs in the future to reflect this?
What you probably seen that actually one of the reasons why we consulted on ICP 14 and 17, because ICP 14 is the basis of valuation and ICP 17 is the base of capital adequacy. And the reason is why we didn't change this ICP before we change it now is actually because we wanted to take into account development in the ICS, so that actually we didn't have to do much of the work twice. So effectively, what is likely to change is not the ICP per se, but the part of COM frame which you see now in the consultation document as level 1 and level 2 text, which not the substance, but the way it's written may need some adjustment to reflect the type of style of the text, which is used typically for ICPs and COM frame. But once they will be agreed, there will not be change in substance, will be just editorial changes to reflect the style of the ICPs.
Okay, thank you. And then maybe you can help me to better understand what level of soft law the level 1 and level 2 documents of ICS belong to with a view to implementation assessments. so implementation assessments by the International Monetary Fund or the IAIS. So would a member jurisdiction's translation of the ICS into local law be assessed against both level 1 and level 2 ICS documents, or only against the ICP?
International active insurance groups will be subject to CONFRAME. So this is an additional standard on top of the ICPs. So whatever will be part of the CONFRAME, which is the level 1 and the level 2 text, will be part of any implementation assessment. Just to clarify that level 1 and level 2 differences stems from an internal classification from the IAIS, which reflects actually the speed the IAS may want to bring forward some changes. For example, whatever is in level 2 may require may be less stable because it may include calibration, which may need to be revised more promptly compared to the level 1 text, which doesn't require to be revised pretty quickly. But I let Roman Passero from the Secretariat to provide to complement his answer.
So thank you very much, Paolo. I have actually nothing to add. The implementation of assessment of the ICS will be against both the level 1 and level 2, which both form the standard. Thanks.
Thank you.
Next.
Are you able to clarify, please, the distinction between the role of the ICS standard and the ICP 14 and the ICP 17? I must confess to being a bit confused as to how these three things interact together and why they are different and why there's three documents and it's not all in the same one. If you could clarify that, I'd find that very helpful.
The insurance core principle applies to all groups and legal entity irrespective of size and cross-border activities. The ICS and CONFRAME, actually CONFRAME, the Common Supervisory Framework, applies only for international active insurance group, which are those groups which have a certain size, which is typically measured by over 50 billion of assets or 10 billion of US dollar premium. And they also have an international criteria, which is 10% of the premium needs to be written outside the main jurisdiction, and they need to be operational in 3+ jurisdictions. So that's the difference. So effectively, in terms of the proportionality of the IIS, if I can simplify a bit, you have requirements which apply to all legal entities and groups, which are the insurance core principle. And then you have an additional layer which apply to those firms which are large groups which operate cross-border, which is CONFRAME.
Thank you.
Does it make it clear? Next.
Hello, this is Richard from Milliman in Hong Kong. Can you hear me?
Yes.
Hi. So I understand that the ICS is intended to be a minimum standard for group capital requirements, which that implies that the opportunity is still there for group supervisors to implement a standard that is higher than the ICS. Is that correct?
Yes. I mean, you typically, from a European perspective, probably you use to maximum harmonization type of standards. So effectively, the standard needs to be implemented as it is. There's no potential for any changes. But the ICS, like all standards, for example, coming from the Basel Committee, are minimum standard.
Right.
Minimum standard doesn't mean low.
And do you have, I mean, presumably there will be some sort of assessment process to assess whether or not a group-wide supervisor's group-wide capital requirement is at least as prudent as the ICS, but perhaps that the details of that hasn't been identified at this stage. Is that fair?
Correct. I mean, there will be an overall CONFRAME implementation assessment, which will start at some point in the future. I don't know if you're familiar, for example, with what the IIS has done for the holistic framework, what we call the targeted jurisdictional assessment, which involve 10 jurisdictions which have been assessed about their compliance or implementation with the holistic framework. So I expect something similar will happen for that. That's what the type of activity the IIS typically does. But on top of that, I mean, you know that all jurisdictions are subject to every 5 years to a financial services assessment program, most commonly known as FSAP, carried out by the IMF and the World Bank, and also as part of this assessment by the IMF and the World Bank, there will be an assessment of compliance with international standard, depending on ICPs and CONFRE.
Okay, thanks. And will ICS be a requirement to produce it as well, you know, to enable comparability across the globe?
One of the aim of the ICS is actually to enhance convergence of supervisory practices and create a common language for the supervision of international active insurance groups.
Yeah. Okay. Okay. So on that subject then, on aggregation methods, can you give us a little bit more about the time frame for reaching a conclusion and a decision on aggregation method?
Let Roman Passero from the Secretariat to answer this question.
So yeah, thank you very much, Paolo. So the time frame is as we published. We have agreed on the criteria for the comparability assessment. We plan to start the comparability assessment at the end of August, where we receive the data to support this comparability assessment according to the criteria, and we'll plan to make a decision on whether the AM is comparable to the ICS by the end of the monitoring period, so along the same overall timeline as the finalization of the ICS, so by the end of next year.
Okay, that's fine. Thanks. And in terms of the implementation timeline for ICS more generally, do you have a time frame in mind for that? Because I suppose I'm thinking that I think this is by the time the full year 24 results come in, that will probably be August. So is there a delay in the overall implementation timeline as a result?
So on that, so we plan to adopt the ICS in November 2024. And actually, that's a very valid question, which will be whether there will be time to be given to our members to implement the ICS. So this is something that we are currently discussing to see whether there's a need for that, to allow for time. We can consider that, of course, thanks to the monitoring period and quite the long road to deliver the ICS, and the fact that we had a very extensive participation to the monitoring period from those who should be subject to the ICS, which is the IAGs. Maybe it's a bit different than maybe other standards where there's probably more time needed to the implementation, but still there might be the need for allowing for some time. So the IAS is going to consider this question and come to some provide some clarity as early as possible. As you may have noticed, we are not only consulting on the ICS, but we are also consulting on the economic impact assessment of the ICS. And I think that if a stakeholder, you want to provide any particular views about the need, for instance, to allow some time for the implementation of the ICS, maybe that's something that you can include in your overall comments as part of the economic impact. Thanks.
Great. Thank you.
Next.
Paolo, it's Hugh here. Just a quick question. In relation to the gap with adjustments, I can see clearly it's not part of the candidate ICS. From the slides, is that a suggestion that it may come back on the table in due course, or is it off the table? I'm just trying to understand what the status on the gap with adjustments is.
I think that the short answer is we are continuing to collect data on gap classes, on different gap classes, but is not part of this standard. So it's not part of the candidate ICS as a PCR. Maybe at some point in the future, things gonna change, but is, you know, if you consider for another version of the ICS, not for this one.
Thanks.
Next.
Hello.
Hello.
Hello. This is Kosho Makozono from Tokyo Marine Holdings from Japan. Can you hear me?
Yes.
Oh, okay. Thanks. I have one question. So based on this this year's consultation, I think you will update the technical specification of candidate ICS as a PCR. So with respect to the field testing in next year, like 2024, I know this is very early stage, but do you have any plan, like, are you thinking to do the field testing for both ICS version 2.0 and this updated candidate ICS as a PCR, or are you thinking to do the field testing for only the updated candidate ICS as a PCR? Just wanted to know your current thought.
Thank you very much, and this is an excellent question, and I think the answer to this one will depend on what the outcome of this year data collection tell us, and also what the feedback from the consultation tell us, and also what the preliminary feedback from the economic impact assessment tell us. So if, for example, the consensus is actually that we got it right this year, we are minded to just collect the candidate ICS as a PCR and make the life of our volunteer groups easier, and that may streamline quite a lot the process in terms of calculation and so on, because you will only have to submit the candidate ICS PCR. However, if we have to make significant changes, which I hope is not the case, then we will need to consider that we will need, in any case, we will need to have discussion also with our volunteer groups ahead of that to make the to decide and to get their feedback too.
Okay, understood. Thank you.
Next.
Hi there, it's Angus here from Insurance Europe. I had a quick question on the changes to the non-default spread risk. Understand you've made the changes to accommodate the new term structure, but do you expect, as a preliminary view, that the changes will have any impact on the level of capital requirements for the non-default spread risk, or will it broadly remain the same?
We expect to a certain extent that as long as you are fully matched, you should not have an impact on the spread risk. If you are mismatched, to a certain extent, you may be caught out of that, but you still benefit from the benefits you get from the increase to the increase on the value evaluation side should be much higher. And that's our expectation. To a certain extent, the changes that we made to the term structure and NDSR provide a clearer purpose for the non-default spread risk charge.
Okay, thanks, Paolo.
Thanks, Angus. Next.
Hi, Paolo, it's Urs from Swiss Re, if I may come in.
Yes, please.
A question of data collection. We have already touched upon the 2024 collection. What about 2025? The standard is finalized, so there is actually all on the jurisdictional level, so there is no need anymore for IES to collect any data. Is that correct?
Are you volunteering to provide your data or provide first data in 2025, Urs?
I'm just suspicious about the discussions, so that's the reason why I'm asking, Paolo.
I think, Urs, considering the amount of data, the amount of information which collected, from firms and the patient that all volunteer groups had starting from 2013. I think we would like to give you a bit of a break after next year data collection.
That will be much appreciated. Thank you very much, Paolo.
Thanks, Urs. Next.
Just a quick follow-up. Is the technical specification for candidate ICS available?
I think they've been published on the ICS website. Correct me if I'm wrong, Aurelian.
No, that's correct, Paolo. All technical specifications and also related documents like template, yield curves, and so on have been published on the ICS website end of last week at the same time as the consultation document. So you will find the technical specifications part 1, which correspond to ICS version 2.0, and technical specifications part 2, which correspond to the candidate ICS as a PCR.
Okay, thanks.
So if you want to look at the changes, you need to look at part 2.
Yeah, thanks.
Thanks, Olaf. Next. Do we have any more questions? Last final call. Do we have any more questions?
Paolo, Sylvie is just indicating that she received a question by email. So if we can just wait a few seconds until we get the question and we can then read it aloud.
Good. In the meantime, if okay.
Hi, Paolo. I just sent you the question.
Yeah, I saw that. Thanks. I think, if I understood correctly, so that we never changed the ICS 2.0 because it's what we call the reference ICS. And the reason why we never changed the ICS, the reference ICS, is because we wanted to have a stable version of the ICS onto which compare results over the years. So effectively, we wanted to isolate any potential changes due to the cycle and have a reference point like the reference ICS. And this year, effectively, the reference ICS actually provide us the reference ICS of this year and the reference ICS of last year, considered in parallel with the candidate ICS, enable us to isolate the changes to the solvency ratio, which are due to change in market condition, change in yield curves, compared to the changes which are driven by the enhancement to the ICS we added through ICS 2.0. So the plan is not to update ICS 2.0, but always any updates will be on the candidate ICS as a PCR. Any more questions by email, Morian?
Not that I am aware of. Just checking with Sylvie as well. Sylvie, did you get any?
That's all.
Okay.
That's all I received.
Okay.
A question on the front, please, if I may. How will the IIS decide on whether an implementation is acceptable? For instance, the candidate ICS will be based on a Moche approach for the risk margin. So in an implementation, should you have the Moche approach or can you have something else? Or?
We set the standard. So effectively, the standard sets what basically what should be on valuation, what should be on that. Then there will be an implementation assessment of ConFrame, and there will need to be an implementation methodology will need to be devised, and we'll have to measure what is an acceptable or not acceptable outcome with respect to that. But these things down the line when we discuss the implementation assessment more than now. Now we're setting the standard. But that's a very good question. Any more questions? No, if I know not any more questions, I think I really appreciate the inputs you provided us today. Just to remind you that we will, there is time until the 22nd of September to provide comments to the consultation. We expect and we encourage you to provide comments on not only on what you don't like, but also what you like about the current framework. And with that, thank you very much for participation. And unless there are any call from any more comments from Roman and the Secretariat, I think we can close the call.
Just maybe one very small thing, Paul. Actually, the deadline for responding is 21st of September. But that's, yeah, just minor thing.
Thank you very much, Aurélien. And please enjoy the consultation. And I think, if you're going on the beach and you don't know what to do over the summer, take the consultation document under the parasol. Thank you very much again for your participation. Talk to you soon. Bye-bye, guys.
Thank you. Bye.
Thank you. Thank you.